been YouTube pretty much. Okay, make sure you remind me so I don't turn the thing off. Close it without saving it. Okay, and let's go ahead and let's work these. Oh, in here, well, I'll get to it when I get to that question. I'll make that comment. So let's go ahead and let's take a look at these questions. And we've got this company, and they pay $420 for an asset. Shipping costs are $15. Foundation work cost $8. An additional water line to be run to the equipment cost $3. Labor and testing costs totaled $6. Materials used in the testing cost $3. And they want to know which of these should be capitalized, should be debited to the equipment account, right? And remember, we said that any cost you incur to get a piece of equipment to your facility so that you can begin using it in your facility, anything you have to do to get it ready for that purpose is part of the cost of that equipment, right? Okay. So in this example, you couldn't have started using this thing, in this problem, you couldn't have started using this thing unless you incurred all those costs, right? And so all of those would be picked up. Okay. All right, good. Number 2, and we want to figure out what should be the cost of the land. Now, what happens? Any cost that we incur to get the land nice and flat, so we can be, again, using it as part of the cost of the land. If we start, what? Digging for the foundation or whatnot, that's part of the cost of the building, right? So you look at this and what? Demolition of the, obviously, you know, the original cost of the property is always going to be part of the answer, of course. You know, that's, you can't get any of the answers without including that. And then demolition, yes, that's getting it nice and flat, right? Legal and other fees to close escrow, yes. Any legal fees, anything you have to incur, property, title insurance, you may see that, where they search to see if there's a lien against the property or something. Anything, cost that you incur to take a piece of property free and clear of title and get it ready for its intended use is part of the cost of that. So yes, proceeds from the demolition of the scrap, that comes what? Off the cost, because we're going to get that money back. And so the answer is 477. Yeah, if they listed excavation cost here, well, I mean, you say everything except. I mean, if they said, um, you know, excavation costs, they said something associated with the building, then that's building, right? I mean, you know, you said everything except the excavation. If they start listing things that are, you know, building the foundation for the building or something, that's building, right? Okay. Okay, good. Um, Simpson and Homer, okay, haha, acquired office building, and they paid a lump sum of 2.4, and then they start giving me the appraised value of the separate items here, the land, the building, the fixtures, and they want to know which of these combinations, or I guess D would be none of them, would be appropriate for the allocation of that, what? Of that sales price of 2.4. Okay, so, you know, the problem with this problem, guys, is it's a little long, but you're going to have 3 hours to work it. So I might give you something like this, but it's pretty easy in that you do what? You basically sit here and add up the relative fair values that they give you in the appraisals up there. Okay, those are the appraised value. That gives you a total, and then you figure out what percentage each one of those constitutes of that total. For example, 1.3 divided by 2.6, the building constitutes 50%, right? Okay, then you take that total purchase price and you allocate it based on the relative percentages, and that's what gave you the correct answer here, which I guess was what, B? Okay, the only thing you got to be careful with this, because when I was preparing your actual final, and I was looking at one, and I think it only asked me the value of one of them, I made the mistake of applying the wrong percentage to the one they were asking me because I was kind of like watching the football game while I was doing it. Okay, so, I think the Raiders were losing at that point. Okay, so, just be careful. It is very easy to make that mistake, to calculate all these percentages, and then all of a sudden you pick up the wrong percentage and they're not asking you about that asset. Okay, other than that, this should be pretty easy. Okay, all right, now number 4. In a non-monetary exchange of equipment, if the exchange has commercial substance, a gain is recognized. Transaction has commercial substance. That means that we're just going to calculate gain the way we always do, right? Which is the difference between the higher fair market value and the lower book value, right? And so the fair value is there when the fair value of the surrendered equipment exceeds the book value. Okay, number 5. Alamo exchanged equipment and $18,000 cash for similar equipment. The book value and fair value of the old equipment were $82,000 and $90,000. Do you guys understand what it means when it says respectively? Sometimes I get students during a test will say, what's respectively? Okay, that means that what the first one applies to the first number, the second one applies to the second number. So fair value of the old equipment is 80. Book value is what? 82, and fair value is 90. And so what happens? We've got an $8,000 difference. Since the transaction has commercial substance, then we've got what, an $8,000 gain here? And the gain, parentheses means loss, gain means no parentheses means gain. Okay, now, the only thing I don't like about this question is I think, Spiceland, I'd like to slap Mr. Spiceland sometimes, or have a long talk, not slap him, but have a nice long talk with them. I don't like questions that, expect you to know parentheses versus not parentheses. Give me a break, okay? But, know that parentheses would be a loss and 8,000 would be a gain. I guess I could change that so that it doesn't do that, but I don't like when they do that. Expect you to know the parentheses here. Okay? I guess they put loss. I guess it's okay because they put loss what? And they showed that was in parentheses. So that's not too bad. Now, hear this. Your free response question is going to be a non-monetary exchange. I don't know if it's going to have commercial substance or not, but you're going to have to give me the journal entry that goes with that. That's going to be, I'm going to give you a fact pattern, something like this, and then you're going to have to do the journal entry that goes with it. And what was nice about the answer key for this, it gave me the journal entry, and I think I give you like 3 or 4 of these here to practice with, and it gives me the journal entry every single time. Okay. Now, the way you put together the journal entry is in the order that I'm going to do it right here for you. I'm going to number it for you. First, take the book value of the old equipment off. Okay. Now, if they just give you the book value, then it's just a credit for the book value. If they gave you the original purchase price and the accumulated depreciation, you'd have to, debit the accumulated depreciation, credit the original purchase price. That'd be equivalent to taking the book value off. Then go ahead and if there's any cash involved in the transaction, do the cash. Now, I don't care for the way they do these. Alamos Company exchange equipment and $18,000 cash. I will make it clear whether they're paying the cash or receiving the cash. Every time I read one of those, I got to end up looking at the answer to figure out who the hell got the cash and who the hell paid the cash. And in accounting, we would know if we paid the cash or received the cash. We wouldn't have to sit there and read a stupid problem to figure out what went on. So I'm not interested in your ability to read this to figure out who was who. So I'll make it clear. But in this example, they did what? They paid the cash, so we go ahead and we're going to credit the cash for 18. That's the second thing we do. The third thing we'll do is we'll stick the gain in there. We know that it was a gain, so we have to credit gain for 8,000. And then number 4 will be to debit whatever the equipment is, and it's obviously the number that's going to make the journal entry balance, right? But remember, we said that the um, value of new equipment, whatever, will equal book value of assets surrendered, given up. You want to say given up? Surrendered sounds like, yeah, like somebody came and stuck you up for them. Given up, right? Plus the gain, right? Okay. Now, if you look at this problem, the book value of the assets given up was what? They tell me 82 plus the 18,000 cash is a asset that was given up, wasn't it? Okay, and the book value of the cash is always whatever the cash amount is. There's no difference between book value of cash and the amount of cash. And then plus the gain was what? Gain was 8,000. And if you add all that up, you get that number, 108,000. Okay. All right. I like to use that. I mean, there's other ways that, you see people doing this, and they'll say, well, it's the fair value of this. What I like about this is this works even if the transaction lacks commercial substance. I don't like that you have to switch back and forth and how to calculate the value of the new property when there's a difference between commercial and not commercial substance. If you do it this way, it works in all cases. Okay?
And so the 18,000 is part of the book value since that's also what you gave up to get the new equipment?
The book value of the assets given up. It is the book value of the assets given up. Book value of assets given up. You gave up equipment that has an $82,000 book value. You gave up cash that has an $18,000 book value, which the fair value and the book value of the cash are exactly the same, and plus the gain. And you've got a gain. Plus the gain or minus the loss. Or minus the loss. Okay? Now, if we pay cash, okay, what we're going to do is we're going to take the book value, but we're going to subtract the cash if we paid the cash for it. I mean, not paid cash, but received the cash for it. Excuse me. Receive the cash for it, then you subtract the cash. This works every time. Okay? Okay, good. Let's look at the next one. Alamo Company exchanged equipment and $18,000 cash. Again, they paid the cash. I don't know. Why don't they make it clear that they paid cash? Exchange equipment and $18,000 cash for similar equipment. This is the same problem, isn't it? And all they're telling me now is the transaction what? Lacks commercial substance. If it lacks commercial substance and I did what? And I paid the cash, I'm not going to recognize the gain unless the cash constitutes 25% or more of the total consideration, which in this case it does not because the cash is what? 18,000 and we gave up consideration of 82 plus 18. So it only constitutes what? 18% here. And since it's less than 25, then the person paying the cash, the company paying the cash, will not recognize the gain, right? If we were the company receiving the cash, then what? Then we would have to take 18% of whatever the gain was. Okay. Okay, good. Question on that? The other thing I like about this, guys, notice book value, and this is the textbook put this in there, and I left it in there because this is consistent with how you do it for everything. Book value of the old plus the what? Book value of the cash gave us the recorded amount for the new equipment. Okay. Okay, good. New building, whatever this thing is. Okay, number 7. Horton Services exchanged land and cash, meaning they paid cash. Okay, land and cash for similar land. The book value and fair value of the land were $9,000 and $100,000 respectively. Assuming the exchange has commercial substance, Horton would record new land and gain or loss of, and they give us the options here. Now, what happens? The gain is pretty easy. It's 10,000. It's what? It's the book value of the land versus the fair value. There's a 10,000 gain there, isn't there? Okay. Now, the new value of the land, and this is what I'm talking about, knowing how to do it, because if I give you a multiple choice question like this on the exam, you don't want to do the whole journal entry and plug it to figure out what the new land comes in at. Okay, so I would simply do what? I would say the book value of the land was what? 90,000. The book value of the cash was what? 5,000, and we had what, a $10,000 gain that we took? Works again. Okay. Now, if they ask you the whole journal entry, again, I would do book value of old. I know I got to get rid of that. The cash is a piece of cake if you know they're paying the cash, if they word the problem correctly. Take the gain, and the fourth one that you do is this. And I will, of course, give you partial credit for getting the pieces of the journal entry. CPA exam does not do that. So I'm being more generous to you than the CPA exam here. It does not do that. It only gives you partial credit for an incorrect journal entry. There is no way in the world that anyone should end up with a 0 on this question if there's cash going out of whatever it is, 5,000. To take the book value of the land, you can almost get the whole journal entry with easy, and then you should be able to plug in whatever comes in if you can't remember that little formula we've been talking about, right? Okay. Okay, good. Number 8, and I'm giving you quite a few of these guys because, again, your free response question is going to be something like this. Horton stores exchange land and cash at 5,000. The book and fair value of the land, isn't this the same question? Oh, now it lacks commercial substance. Okay, good. So the gain is what? 0. Okay, and then we have to figure out what the land is going to come in at, and it's book value of assets surrendered, isn't it? Okay, so we gave up the what, land of 90 plus the cash of 5,000. This is why I like using that book value approach, because I don't have to shift gears between commercial and lacking commercial substance and having commercial substance.
We just don't add gains or losses here because it lacks commercial substance.
There is no gain. Is to me the better answer here. There is no gain, right? Because you had to know there was no gain here to be able to answer this question correctly, right? No gain if what? If I'm paying cash and the cash constitutes less than 25% of the total consideration received, which this is what? Way less than 25%. I don't have to calculate that to figure it out. Okay. Number 9. Bloomberg Inc. exchanged land for equipment and $3,000 cash. Again, I'm thinking they're paying the cash here. No, you see, they're receiving the cash. I mean, what makes this different from the way they articulated it before? I mean, what am I supposed to get in their head and know what theirs mean? Could they receive the cash? So I'm going to have to edit the questions that I take from the test bank to make sure you'll know if they're paying cash or what? Receiving cash. And I don't see that I'm like dumbing down the situation for you on that, because what company doesn't know if they paid or received cash? Why are they making it a mystery? Okay. All right. So what happens? We assume the exchange has commercial substance. So we know. Oh, let me say one thing. Remind you of one thing quickly. If a transaction lacks commercial substance and there's a loss, should I take it? Always take the loss, right? We only worry about the commercial or not commercial substance relevant to should we take the gain or not, right? Okay. Okay. So anyway, let's look at this. Assuming this transaction has commercial substance, and so we've got what? We've got a book value of 104 and a fair value of 90. So we know we've lost what? Isn't that 14? So, I mean, this thing's a piece of cake right out of the gate. They only have one $14,000 loss here, right? Okay. But let's go ahead and see if our little rule holds now for obviously the 87,000, which is what? Book value is 104, but I did get some what? Some cash out of that. So we're going to go ahead and subtract that cash. To a certain extent, I sold a piece of that equipment, right? Okay, so I go ahead and I subtract that cash I paid, and then I do what? And then I subtract the loss here of 14,000, and when I do, I should get this 87,000, right? So it's book value of what? Of the asset surrendered, yes, but then I have to do what? I have to subtract any cash received. So you can look at it, hey, net the book value of the assets I surrendered was whatever, 101, whatever that is, plus, or not plus, but then what? Minus the loss because it's a loss, not a gain. Okay. Okay, are you getting tired of these yet? Okay, assume the transaction has commercial substance. Well, how is this one different than the other one? Same exact question? Okay, well, I loved it so much I put it on there twice. Okay. Um, I think maybe what I was thinking is if it lacked commercial substance, it's what? The same thing. Maybe I was thinking I was going to change it to lacking commercial substance. You still take the loss, don't you? Okay. So there would be no difference there between lacking and having. Okay. All right. So that's it for those. I will potentially give you a multiple choice question like that. I will absolutely, I promise, unless I die before I'm able to give you the exam, there will be a question in which you will sit here and you'll have an exam on Wednesday, right? What time? 12:15. 12:15? Don't be late. 12:15, in which I will give you a free response question. You're going to have to give me one of these journal entries. Okay? All right, let's take a look at construction period interest. Okay? Now remember, we had a set of rules for construction period interest, which is what? We have to either calculate or we'll be given the what? Weighted average of accumulated expenditures. So I'm going to probably make you calculate that. To figure out the amount of interest that is capitalized, we will have to do what? Take the interest rate that is relevant to the specific borrowing and apply that interest rate to the weighted average of accumulated expenditures, right? Okay, that will be the amount of interest that gets capitalized unless it is more than what? Than the actual interest expenditures, right? Okay, then what? We said if you have weighted average of accumulated expenditures that is in excess of the specific new borrowing, then you have to apply a second interest rate, and there'll be a second interest rate in the problem where I'll give you the average interest for all their other borrowings or something. You'll have to pick that up for the excess, okay? If there is what? Any money that is invested because they're not ready to begin using it for construction yet, and there are interest earnings on that investment, you do not net that against the capitalized interest, right? That's it. That's the rules. Those rules were on a couple of slides there that we went through for the chapter. What is this? 10, 11 lecture. Okay. Chapter 10 is where the book talked about this. All right. So we come over and blah, blah. They start this. Huh? Oh, okay. Yeah, it does. It's just that it's a different, what did you count? Huh? Da-da-da. Number 12. And there's the question, right? What am I missing? Oh, where was I? Up here? No? Huh? Oh, there's no number 11? Oh, sorry. There's no number 11. I just put the number next to. But okay, look, guys. This I skipped number 11, so this starts number 12. Here they tell me here's a table of information, and then um, they tell me more. Okay, so I don't care. Yeah, oh, right, exactly. That's where we're given the information, and then we have to use that information in this fact pattern down here to answer the question, right? Do you guys know what's going on here? Okay, they're giving me a table of information. I have to use that along with the paragraph information to answer this question, right? And I don't care what numbers it says. We're clear now? I know, but I just took that out because it was in the way. You can answer this question with everything that's right here. Everything that's right here, you can answer this question. Okay? Are we clear? Okay. All right. So they want to know what amount of interest should be capitalized. Okay. Now, notice they started this project, what, in July? Okay. So July 1st to December 31st is how many months? 6 months. Okay. So what happens? They take that 54 million and they multiply that by 6 because that was outstanding for the full 6 months of which construction had begun, right? It's during the period that construction's been going on, right? Okay. Okay, good. Then what? Then they spend another 22 million on October 1st. And so now we have what? We have an amount that was outstanding for all of October, all of November, all of December. So we rate that 3/6 of the construction period. Okay. And so we go ahead and we weight those accordingly. And my weighted average of my accumulated expenditures is what? 65 million, and I multiply that and they tell me that they borrowed 70 million, which is more than the 65 million. So I know I don't care about these other interest rates that are in this problem, right? I use the interest rate on the specific borrowing. The loan was outstanding through the end of October 2018, so it's going to still be outstanding next year, right? Okay. Then what? The company only other interest bearing debt was la 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 la. I don't care because it's not exceeding the specific borrowing, right? Okay, so what's the amount of interest that should be capitalized? It's going to be the 6% interest rate specific to this borrowing times what? Times, and they only started borrowing that money in July 1st, didn't they? So it was only outstanding for half the year. And so the amount of interest that should be capitalized is 1.95. So we're going to what? Obviously, we have capitalized the 54, right? Because we spent that money on the construction of that. So when you spend money on the construction of something, forget interest. Even if you just had the cash sitting in a pot somewhere and you spent it in construction, you would capitalize that, wouldn't you? Credit the cash, debit the construction in progress, whatever. Okay. And then what? 22 million has been capitalized, as has what? The 1 million. Now I don't know where to put the 1.95 million of interest. Go ahead.
So I understand the 6 out of 6 months for June, but then for October, is that just because that's a leftover 3 months of the year?
Yes, because it was only outstanding for 3/12 of the year, or 3/6, I should say, of the construction period, because we're using the construction period here. You don't start capitalizing any interest until construction begins, right? And they told us that the construction began in July 1st, so that's when we go ahead and start. That was another rule that I didn't articulate when I summarized the rules. Okay? But they've capitalized this much, haven't they? The amount they spend, and we just said we're capitalizing the interest, aren't we? Okay? So now our total amount that has been capitalized as an expenditure should be this 54 plus 1.95 plus 22 should give us 77.95, right? Okay, now this is important, guys. When we get into year 2, okay, and they ask me now what should be capitalized what? Or they ask me what's the interest to capitalize in 2018, I have to count the amounts that what? Were already spent on this, the expenditures already on this, which is the 77.95. And since they finished the construction in October, then that amount's going to be outstanding for what? 10 out of the 10 months of construction, because we only capitalize interest for the period that is actually where construction is actually going on. Okay, so since this project ended in October, we are only going to count this as 10 months of actual construction, right? Okay, and so what happens? That amount was outstanding for the whole year because it was from last year forward. We've got this 30 million that they spent what? On February 1st, so that was only outstanding for 9/10, right, of the construction period. Okay, February 1st to October 1st or October, I guess they're counting it through October 30th. Huh? I'm sorry? Yeah, they counted it through to the end of October. All of February, all of March, all of May, April, all of February, all of March, all of April, all of May, all of June, all of July, all of August, all of September, all of October, but they said they stopped the construction October 1st. Oh, does it? Oh, at the end. Thank you. Okay. That's why they're counting all of October. Okay. So it didn't end October 1st. It ended what? October 31st. So it's the full 10 months, right? You count October, all of October. Okay, so that's where they're coming in with the 10 months. January 1st to October 31st is what? 10 months. Okay. February was what? We don't count January. We start with February, right? Okay, and that goes to the end of October. That's 9/10. And then 7/10 because what? We had that first amount in April, all of May, all of June, all of July, all of August, all of September, all of October, 7 months. Okay, so that was outstanding for 7 months. And then the amount that was spent on October 1st was outstanding for what? For 1/10, right? Okay, so you got to watch your dates, guys. Be careful because if they spent the money October 31st, we wouldn't count that at all, right? That wouldn't have been outstanding at all for the period. Or the money is spent on December 31st, don't count that money that gets spent December 31st because that was not outstanding at all, right? For December, okay? But we get that. That gives me what? The weighted average of accumulated expenditures, which is 124,000.25. Okay, and this asks for what? The weighted average of accumulated expenditures. So we just had to sit here and use that 124.25 for the weighted average of accumulated expenditures. Because it was outstanding all of the 10 months in 2018. Counted on what books? It's already there. We don't count it twice. It's a balance sheet item. this only had a balance sheet effect. 77.95, there would have been a debit to construction in progress, and we'll just say credit to cash for 77.95, right? For that whole thing. Okay, now if they had interest expense that was more than this 1.95, which they did, okay, so we debit construction in progress for 77.95. We credit cash for 77.95. That's the amount that they spent on the construction plus that 1.95 of interest that they've capitalized that they spent. And then there's obviously interest costs that are in excess of the amount that got capitalized. Well, that's an expense. So we would debit interest expense for that difference and credit cash for that difference, right? I don't care what it is, whatever it is, that part would be expense. So we're just capitalizing that portion of interest that we did by applying the interest rate on the specific borrowing to the weighted average of accumulated expenditures. That amount gets capitalized. Well, that's a purely balance sheet thing. It sits on the balance sheet, doesn't it? But those expenditures are still outstanding as we go into the new year. They were outstanding for what? For the entire 2018. Not 2017. We're going to 2018 now. It was outstanding for the entire 2018. So we put a 10/10 on that. Then, because we got to spend money to construct this asset, right? So we go ahead and we start spending more, and those were outstanding for the fractions of the year, since some of it didn't get spent until February, some until whatever it was, April, etc., whatever. That's why we weighted those accordingly. Okay. Okay, good. Number 14. I took it out. I don't have it here anymore. I took it out because it seemed like an orphan. I couldn't figure out why I had it there. What was it? A next question on that? I took it out. So don't worry about it. I took it out because it got stuck down there somehow. I don't know how it ended up down there. I couldn't figure out what was going on, so I just took it out. Okay. Okay, good. Now, I'm not going to do the depreciation questions right now. I will come back and knock out as many of those as I can after we have started to look at the Chapter 12 questions. Okay, because I want to make sure we have some time with these, because these are a little tougher, and I don't want to leave these sitting on the table, and then we wish we had spent the time with them. So on January 1st, 2018, Everglade Company purchased the following debt securities and properly accounted for them as available for sale. And then the question asks, what should I report on my statement of other comprehensive income? And what's going to go into other comprehensive income is the amounts that I put in the valuation, or what do they call that? They used to call it a valuation adjustment, and they changed the name. You know, FASB needs to take a vacation and quit changing things that don't help us at all. Fair value adjustment. Okay, fair value adjustment. Okay. All right, so let's go ahead and let's take a look at this now. And that's the amount's going to be our other comprehensive income, is the difference between fair value and cost, right? And so this one had a what? Fair value over cost of 15. DEF dropped in value, didn't it? Okay, so that's a $7,000 loss. And then the what? The XYZ security is up so we got a $12,000 net gain here for these. That's going to be what? That's going to be a credit to the adjustment, debit to the adjustment for fair value, credit to other comprehensive income, right? Okay. Okay, good. Number 22. When the fair value And you guys told me to put more questions like this, right? We don't have to do a lot of calculations. Where the fair value of an investment in debt securities exceeds the amortized amount, how should each of the following debt securities be reported at the end of the year? Held to maturity, we leave it at amortized cost, right? Available for sale and trading, although this didn't ask it, would both be fair value. Okay, number 23. The following data pertains, and this wants to know what amount is in the accumulated other comprehensive income at December 31st, year 2 here, right? Okay, now what happens? In year 1, we would do what? We would sit there, and first of all, do we care about the trading security? We do not care about the trading security. That information is just there to distract you. It is irrelevant. Now, I could give you the same question. Not a bad idea. Change it to what's reported on the income statement, right? No, what's reported on the income statement, in which the answer would then you'd have to look at the trading securities, right? But for my accumulated other comprehensive income on the balance sheet, what's going to happen? Well, first, I'm going to look at the difference between year 1 and the original cost, and there was a $30,000 what loss there. So I will debit OCI, whatever, unrealized. I'm just going to put un here. Unrealized. Debit OCI, unrealized. I'll just put unreal. Okay. For what? For 30,000. I'm going to credit the what? Uh, Valuation adjustment. What do they call it? What do they call it? Fair value adjustment? Huh? For 30,000? With me so far? Okay. Then I have to sit there and I have to close this OCI, don't I? So when I close OCI Unreal, I'm going to credit it for 30, right? That closes that, and I debit accumulated OCI for 30. And so I'm going to go ahead and I'm just going to tee up accumulated OCI over here, and that was a debit for 30,000, right? Okay. Okay, good. Then what happens? Then I go ahead and I look at year 2 versus what it was in year 1, and I've recovered 10,000, haven't I? So in that year 2, I'll go ahead and I will debit the fair value for 10,000, and I will credit OCI Unreal. This is year 2 now, isn't it? For 10,000. Okay, 10,000. That's 10,000. And then I'm going to go ahead and close that, right? So when I debit OCI Unreal for 10,000 and I credit what? Accumulated OCI for 10,000. And when I credit accumulated OCI for 10,000, now the balance is what? 20,000 in here. Now this question was a little bit generous for a CPA exam question. I think they were being kind of gentle here with the candidate, and that what? They didn't ask if it was a debit or credit or anything. Okay. The other way to have quickly done this would have been to do what? Simply compare the cost to what? To the fair value at the end of whatever year they're asking, in this case year 2. That's what's in the valuation adjustment. That's what's in accumulated OCI. Those two amounts match, don't they? Okay. Be careful with that though, guys. You're going to have plenty of time to work this exam, so I'd be careful about getting too slick with yourself and just trying to do it. If you need to walk yourself through those journal entries, you should have plenty of time to do that. Okay? Okay, good. Number 24. And They purchased 3,000 shares of Eagle Company's 10,000 outstanding shares. Stop. Am I using fair value through net income method or am I using the equity method? Equity method because we're well past the 20%. I will never give you question where it's 21%. It's 19.99%. I'm going to put you well into the equity method if I want you to use the equity method or have you well back into the fair value through net income method if that's what I want. Okay? So, we're solidly in what? Solidly in the equity method. And they say, what is the amount of income from the investment? Amount of income from the investment is whatever the what? Investee's net income is times the investor's share of the stock, which in this example was what? 30%? 3,000 times the 10,000 shares divided by the, I'm not times, but divided by the 10,000 shares. That gives me 30%. The only thing you have to be careful is what? That's 36,000 wrapped strangely. Is they bought the stock July 1st, so we only take what? Half the year's income? So it's 18,000. Now the journal entry here would be to do what? Debit the investment under the equity method. Debit the investment for what? For 18,000 and credit the investment income. Hello? For 18,000. Okay. Now, what about these dividends? What would we do under the equity method? They paid dividends and they paid what? 40,000 of dividends, and they paid those after I had purchased the stock, right? Okay, so since it's after I purchased the stock, I'm entitled to what? My share of all of those dividends at 40,000 times what? 0.3, huh? Times 0.3 equals 12,000 of dividend. Okay, and I would do what? I would debit, obviously, what? The cash for the amount of cash I got on those dividends, 12,000. And guys, I credit what? I credit the investment account for 12,000. So I could give you this same question and say, well, what's the amount of the, how much did the investment account increase or decrease? And the answer would be what? It would have increased 6,000, up by my share of the income, down by my share of the dividends. Right? Debit, credit, up, down, right? Because I reduce my investment by my share of the dividends. Okay? I could say, what is the carrying value of the investment at the end of the year? Well, if I bought what? I bought 3,000 shares at what? $20 per share. 3,000 times 20 is 60,000. So the investment would have been debited 60,000 and cash credited for the 60,000 when I bought the stock. Right? So you would have had what? The initial investment of 60, up by the amount of income of 18, down by my share of the dividend. So the ending balance in here should be what? 66,000? Right? Using the equity method. I bought the stock for 60. 18,000 was my share of the net income, wasn't it? Don't look away. 18,000 was my share of the net income, wasn't it? Okay, minus my share of the dividend is 12, right? Okay.
If the question is just on the income, not the total income.
It just asks the investment income that's going to be reported on the income statement is 18,000, right?
If the question is asking for the total income, it become the 6,000 now.
No. Did I say, what if they asked me the net income? No, I said, what if it asked me the increase or decrease in the investment account? increase or decrease in the investment account is 6. Up 18, down 12. Right? T account? If it said how much did the investment account increase or decrease for the period, oh, I see, because they bought the investment at the beginning of the year. So it increased a net of 66,000 because the beginning balance is 0. Okay. If there was already a balance in there, if they'd bought the stock, say, last year, and they didn't buy any additional shares, and then I asked you what did the investment account increase or decrease, it increased 6,000, didn't it? If I ask you what's the ending balance in the investment account, ending balance is 66,000, right? What I originally had bought it for, debit investment, 60,000, credit cash, up 18 for my share of the income, right? I increased the investment account for that. Down what? Down 12,000 for my share of the dividends, right? What's hard about this? I don't get it. What's the question? Why are you guys looking like I just pulled a rabbit out of my hat? You buy an investment, it goes up. If you're using the equity method, your share of the income is reported as income on the income statement. Your share of the investment income is income on the income statement. You increase the investment account by whatever you took into your share of the income, right? Think of the dividend as a payout of part of your investment. And so when they pay me out, I reduce the investment account. Obviously, I debit the cash, right? Okay. Okay, good. Let's look at this one. Zwick bought 28,000 shares of the voting stock of Handy Corporation in January 2018. Handy announced 200,000 of net income for 2018 and declared a cash dividend of $2 per share on all 200,000 shares of outstanding stock. Am I going to use the fair value through net income approach or the equity approach? Fair value through, what is it? Net income, whatever. 200,000. How many shares did I buy? 28,000. What percent is that? 14%. I'm less than what? Less than 20%, right? So I use fair value through net income. So I'm only going to take what as my investment income, whatever dividends I got. And so they did what? They declared dividends of $2 per share. $2 per share times how many shares do I own? Times 28,000. Should give me 36,000 as the answer here, or 56,000, excuse me, as the answer. Okay. Any questions about any of this so far? Again, I'm kind of, treating these depreciation questions as bald stepchildren. Okay, I won't pick on anybody's hair color. Okay, so um, okay, all right. So let's go ahead and let's take a look at these. Okay, all right. So we've got straight line depreciation. Come on now. 72,000 is the cost minus the salvage value divided by 5. The only thing I might do to you differently on your test. Oh, by the way, before I forget, pretty much 10 questions from chapter 9, 10 questions from chapter 10, 10 questions from chapter 12. Pretty much. Huh? 10, 11, I mean. Okay, let me start over. 10 questions from chapter 10, sorry. 10 questions from chapter 11 and 10 questions from chapter 12. So pretty much divided between the three chapters. Chapter 20 is not on the exam. I will be putting a lecture up there that I'm sure over the Christmas, I'm sure Christmas Eve you'll be watching that lecture with, 50 of your closest friends, whatever. But I will put those up, that lecture up, so that you're able to look at that and still get exposure to that material, but it will not be tested. Okay. For the most part, we really covered how to handle errors, basically what they're talking about in there, how to handle change in accounting principle. Remember the cumulative effect of change in accounting principle. Remember correction of error, change in estimate. That's all it's talking about in that chapter, which we already covered. But I still will go ahead and put something up for that so you have that. Okay. Okay, good. If I had known that that's all they were going to cover in that chapter, I would have saved us time and not covered it earlier, but I didn't realize they were going to get to it in chapter 20. Okay, enough. All right, so using straight line depreciation and the equipment's book value at December 31st, 2019, and the depreciation is 13.2. The book value is going to be what? How many years of depreciation did we do here? No, but we did, they're asking me at 2019, so I would have had to have taken 2 years worth of depreciation, right? So all they do is they take the 72,000 minus 2 years worth of depreciation to get the book value. Okay. Okay, good. Using double declining balance, same fact pattern, but now they want book value at December 31st, 2018, so I only have to deal with 1 year of depreciation here. Okay, so now I'm going to do what? Well, now I'm going to take the 72,000 and what was it, a 5-year life? So 1 divided by 5 equals 20% divided by, not divided, but multiplied by 2 means I'll take 40%. Okay, now look, guys, is it always 40%? Huh? It is not always 40%. I had a student make that mistake. So 28.8 is the depreciation for year 1, 2018, minus the depreciation for year 1 gives me a book value at the end of year 1 of 43,200. What if I ask you the depreciation for 2019? It's what? 43,200 times what? Times the 40% gives me how much depreciation for the next year? Which, oh, okay. Is that the next question? What is it? 17,280? That was the next question.
And so for all these problems on our test, we're just going to assume it's the 40% that you're using?
No, it is not always 40%. 1 divided by 5 is 20% times 2. If the asset has a 4-year life, it'd be 1 divided by 25 by 4 equals 25% times 2 is 50%, right? And I react that way because I had a TA at Berkeley. Everybody wants to talk to the TA. Let's not talk to the dude who's been looking at this stuff for 35 years. Let's go talk to the TA who learned it the semester before me. And the TA told them it's always 40%. Okay. Okay, good. Number 18, and then they blamed it on me. It was something that I did wrong. I'm like, I'm telling you. Okay. Sum of years digits. Okay, sum of years digits. The depreciable base is the same as straight line, isn't it? But now we go and we add up the digits. 1 plus 2 plus 3 plus 4 plus 5 is 15. That's the denominator. And then the numerator, and for the first year, I'll take 5/12. Second year, I'll take 4/12, and so on. Okay? I don't know that a lot of companies use sum of years digits these days. I'm thinking they would use straight line, maybe declining balance. Sum of years digits is more trouble than it's worth, in my opinion. But I have still seen CPA exam questions that like to ask that, so we'll humor them and pretend like it's something that's useful. Why would you do that? I mean, that to me seems like the biggest pain in the world to figure out the life of these assets, add them all up. That's the denominator and the numerator. Give me a break. Who's going to do that? Okay. Now, um, this next one is the what? Using units of production method. Okay. So again, you would take what? You would take the 450,000. You would subtract, and the salvage value on this is what? No salvage value? Okay, good. So we don't have to worry about that. If there was salvage value, we'd subtract it, right? Okay. Then you divide it by the units you think you're going to get out of this thing, which is 300,000. So that gives me $1.50 per unit, which I'm kind of rewriting what's already down here. And then for this year, they say that they produce 24,000 units. So I take that 24,000, that's 36,000 is the depreciation. In the next year, I guess they use 70,000, so I'd multiply that by 70,000 for year two, if I was asked that. So, I mean, the only trick here, let me say something. The way I'm going to make these questions worthy of your exam is to maybe give you the information for 2 years and then slip in on you that I'm asking you instead of 2018, I'm asking 2019, because you're going to get all locked in on 2018 and try to answer the question for 18 when I'm asking you 19. The other thing I might do is I'll put the asset into use halfway through the year, taking an easy straight line depreciation question and making it a tricky straight line depreciation question that you would only take the depreciation for half the year, right? Or whatever the portion of the year is. If I put the equipment into use October 1st, then it's all of October, all of November, all of December. That was only used for 3/12ths of the year, right? So be careful with that and count the years on your fingers. It is the easiest thing in the world to see September and think, oh, okay, September, I got to count September. Meanwhile, you look and it's September 30th, right? So make sure you know when that asset was put into use. Use your fingers to count up the months. Okay? All right, good. So what should be the depreciation during, okay, here it is. During what? During 2019. Now, what's this 36,000 all about? Oh, I see. Okay, yeah. The first year's depreciation is off, right? So we have a remaining depletable amount. And then we use what? We use the new estimate, don't we? Instead of the 300,000, now we say there's only 230,000 units left, which gives me a new depletion base. And then I go forward with that into the 70,000, right? Change in accounting estimate. Just go forward with the new estimate. Okay, questions? Test is on Wednesday. What time? 12:15. If you came in late, make sure you signed in. There will be 40 questions on the exam. Okay? The remaining 10 questions, 30 from the chapters, the remaining 10 questions will be from the first the first two midterms. Not those same exact questions, although I could put those same exact, maybe not. Okay, but they will be questions relevant to what? Chapters 1 through 9. Okay, 10 questions. From that, if you work those questions, okay, I will only use them in computing your grade if it increases your overall score in the class to give you a chance to still get a decent grade in the class if you're struggling. Yes, sir. Save this file. I will. I'll save the audio file. I will save this file as markup and put them both up there. Other question? I can't hear you. Only one free response. I'm not doing two free responses because if I add 10 multiple choice questions and ask you to do a free response, now we're bumping up the potential that I put too much on your plate and we start getting into an unreasonable time constraint for you to be able to do the work. So I'm just going to limit it to the 10 multiple choice questions extra. There will be 30 multiple choice and one free response. You should study those multiple choice questions that I put up for the non-monetary exchange like it's your life. Like if they got it wrong, God came down and is going to say that's it for you. Okay? All right, guys, I will see you on Wednesday. Study hard, okay? Get a good grade in this class. Make